Hi, Warriors. Good CPI day, everybody. Oh, Bran, you're now an agent for Mike Delfino, Michael Wiseman, AJ. How are you? Ingmar, everyone
Morning,
doing
Coach.
okay? Hey, team. Blake, how are you?
Good. It's CPI day. I think we all been waiting for this.
Yeah, you wait all day for Thursday. Let's see what happens. Before we get to currencies here, I just want to follow up on the 3 drive that I talked about yesterday in WTI. And I said, you wait for the red candle. So this was it. I said, you put your stop 50 cents above that candle in case we probe it again, because sometimes 3 drives aren't one candle. Sometimes you get a fractal. So if you did that, you were short from 83.25 and your stop was at 84.56, and we did make a new high. The high was 84.28, so you're still alive on it. You have the option, and I do this sometimes, you have to be flexible in trading. So I'll raise it 50 cents above this high now, just in case we get a fractal. So you see how you have 1, 2, 3, and on the third, you could end up with a fractal. And here you got it, right? You have 1, this was the first one, this was the second one, and maybe we do get a third. So anyway, the biggest point is to not put your stop right above the high of the day or a swing high, but to give it tolerance, let it breathe, because distribution at times is more than one candle. Everyone get it? You
I
guys
like
get
it.
it?
That's why they call you the coach.
Yeah, so I mean, you could recognize the pattern and not know how to trade it. You could say it's a 3 drive, but what do you do? So I have nothing else to offer anymore. That's it. You have all my knowledge now. Okay, guys? All right, so let's get to currencies, getting a nice little bounce in the currencies. That's what I was looking for. I thought that we'd have a little pullback in the dollar. Maybe it's ABC down to 101.5, maybe down to the breakdown, but I think we work lower. I don't think it's going to turn in a day. And with that, you get a little pop in the gold and the silver, and maybe even the yen gives up the ghost here after taking out this high. So we'll see. What are your thoughts? Kman
Good
going
morning,
into the
Dale.
CPI.
Good morning, everybody.
Good morning. Good morning, Warrior.
Morning, Kay.
Hey. First of all, I want to repeat what I said last week ahead of the NFP, is that the option market is less than impressed about what is about to happen. The overnight straddle, which is buying a put and a call at the same level for the overnight, is only trading at 55 pips, or call it 60 if you need to pay up, which is about the same as it was prior to the NFP. And if we look at those moves post NFP in most of those currencies, that's exactly what we got. So that is one thing. So I'm still in a kind of mood to say dare to trade ranges.
Because that's a neutral strategy.
That's the neutral strategy, but you can still trade it. If it goes down to the extremes of what we've seen lately, call it 109.5 or 110.5, it may just not go further if we get data as expected. There's a couple of currencies which are going to react differently to the outcome, in my opinion. So the euro is stronger than most. We've seen that through the euro crosses going higher today. Some of them have put in fresh year highs, euro yen, euro Aussie, and a couple of others. So that is already telling. So that tells me that perhaps the downside on the euro dollar is going to be limited if we get a little overshoot or as expected, then the dollar picks up a little bit on a higher headline number, but it may not last forever. On the other side, I think there's a couple of weak ones, which is, well, the yen, perhaps China, which are going to react more on a strong one. So that's my play for today, is trying to find the strong versus the weak ones and then pick the side on the dollar pair for any outcome of this CPI.
Yeah, and Kman makes a great point. With these euro pairs breaking out, the euro yen. Dale, throw up that one really quick. We cleared the 158 level, big breakout in euro yen, and these breakouts that he's noting, I agree with him. It's gonna help keep the euro supported. Now, one of the other Kman, this is one of the other things.
I'd be careful of a false breakout.
Yeah.
In the next.
Yes.
I mean,
crude's already giving
that
to us today,
all the
right?
shorts are gone. All the shorts are gone over euro yen now.
That's true.
Who's short?
You did have 4 tops over there. So the 4 tops, the 4 tops, recall the 4 tops, Dale.
Yeah, they're a great band, man.
Exactly. So the great band has been broken.
Yeah.
That's funny because Dale, you'd remember in Arizona, we called them the 4 Peaks.
Oh, yeah.
And we have a brewery that named that too. Anyway.
Yeah. Anyway, so S&Ps are going to bounce. I thought maybe a weaker dollar would give the S&Ps some relief. They are getting some relief here. But you look at NVIDIA. Yesterday, they really took it to the cleaners, even with the market called higher. And this was the star, the poster child for AI. And, we can't sell their chips to China. So not great when really the comet and the meteor look like they're coming back down to Earth. I actually think we could see a gap fill there eventually. And in Microsoft, a gap fill as well. And anyway, so tech still looks pretty weak to me. I think you saw rips there still in the stock indexes.
They're taking down the generals.
Yeah.
Dale.
Yeah. When the troops retreat and the generals are at the front lines, the generals get slaughtered.
Yeah, and what happens after the generals usually get slaughtered? I mean, we've seen this song and dance plenty of times over the years.
Yeah. So they led the way up. They're leading the correction. I mean, you could just tell by just looking at S&Ps, put up a daily, and you'll see how it's still holding some moving averages, and NASDAQ's weaker, on the verge of taking out the 50 right here. So NASDAQ led it up, and it'll underperform on the way down. That's the way it looks. So who else is around that has any ideas? Brian, you around today?
Nah, he's off until Tuesday.
Oh yeah, paddle boarding.
Yeah, he's paddle boarding, but Stelios is here.
Hello.
Oh, okay. All right. Well,
here.
this is inflation's become your bailiwick. You're our inflationista, anti-inflationista.
Well, I don't know what I am, but I think it's the most it's the most important measure at the moment by far. Employment is not even close, no matter what people say, in my opinion. Inflation has been the problem over the past couple of years, and that's what central banks have been trying to fight.
Still,
yes, sir.
You're in the majority and not whatever everybody else says. Most of the sales side, there's been a Reuters and Bloomberg picked up on it as well. They're all expecting the yields to come off for the end of the year, down to 360 on the 10s, for instance.
That's scaring me now a little bit.
Exactly. I was
but then again,
just wanted to warn you.
I feel good because I was first. Okay.
Yeah, they probably, but that's the thing. They are listening to the Flow Show and F.A.C.E.
I still think
put out the recommendations.
I think on this occasion they were late, but they are right. So But of course, we wait and see. My view remains the same. I think inflation is going to disappoint to the downside. I'm not saying inflation is never going to pick up again. Far from it. It will. But I think for now, everything that we've seen, all the PPIs, leading indicators, everything is pointing towards a slowdown in prices, a continued slowdown. So
if you see it, Powell sees it, why are they still tightening?
Well, are they still tightening? That's the thing. They've paused now.
Yeah, they just hiked at their last meeting, and they'll probably hike in September.
You know why, right? Because the central bankers are always slow to react. And I don't know why they do that. They were slow to react to increasing inflation. Now they're slow to react to decreasing inflation because they don't want to lose any credibility they have left, whatever it is. So that makes them make the mistake twice, which is funny and also sad. But anyway, I'm not saying I'm better than them, but remember on this show here, we were saying inflation is going higher. It's not going to be transitory. We were saying it, excuse me. We were saying that long before they started hiking like crazy. I mean, if we can see it, why can't they? That's my question.
They can.
Yeah.
Maybe they have a different agenda. I mean, right now, why did Powell pick two things to watch that he wanted to break that had structural and secular shortages, like labor and housing stock? So what? And now it's growth. When he started off, did he say that he was going after growth? Now there's too much growth.
Yeah.
And why? He knew there was a structural demographic problem and COVID with employment, and that was going to be hard to break. Why did he say the Fed is focusing on that? And he knew that there was a shortage of housing stock, and it hasn't changed because rates have gone up. There's still a shortage of housing stock. Why do you think he chose those two areas to make it harder to say mission accomplished?
Good question. I think there's a lot of politics involved in everything, even though central banks is supposed to be independent. I think they clearly are not. And there are forces at play which I don't know and I don't understand. So I can't make any.
Anyone have a hazard a guess? I mean, I don't know for sure, but they said he was going to tighten until things broke. And I'd say what happened with the banks, and now we're getting more downgrades and even a few more failures. Something has broken, and he continues on the path.
Well, I think that they want to make sure that inflation gets to their 2% mandate. You know what's interesting, Dale, and this is something else, Stelios. I've been reading this different places actually. There's a lot of murmurings, and then I mentioned this last night on the trade-off show with Chris Weston, that some central banks might actually accept a higher inflation rate as their neutral rate. And I don't know about that, but I think that people are assuming that central banks might actually stop raising rates and just bite the bullet and say, well, we're going to have to deal with a 2.5% inflation target now or higher. And I found that rather interesting, that might be the case. What are your thoughts on that, Stel?
They could do that. I mean, you say central
banks make up their own rules, right?
Yeah, you say central banks might stop with inflation being higher. Well, look at markets are pricing for the Fed. Only a 30-40% chance of a hike in September. So really, the markets are thinking they're done, which means either inflation drops to 2% or the Fed kind of gets happier with inflation staying around the 2% level. So, or 2 to 3%. I don't know is the answer, but at some point, central banks know that excessive tightening and leaving rates high for long are going to damage the economy. We're already seeing this. We saw the banking kind of semi-crisis that we had. And don't tell me that this was not because of rates going higher. It was exactly because of that, obviously, and very bad risk management. That was a different thing. But we know how leveraged and how mismanaged the whole financial system is. Do they want to risk an implosion? it's a tough call.
Right. And you know, sorry,
Dale.
Dale, I took over the charts because there's some things I want to show ahead of the data. It's going to be, you know, between now, well, today and tomorrow with CPI and PPI, and then, you know, in a couple of weeks when we have Jackson Hole, it's going to be interesting to see how the narrative, if it changes or not. And I think it starts with today's reading, right? Depending on CPI, how it comes out, because as you just pointed out, Stelios, the market is not pricing in. They're pricing in, you know, barely pricing in a rate hike, and they're still pricing out into 2024 cuts. So, you know, if we have a hot reading today, let's just say, you know, for argument's sake, let's say, you know, inflation data comes in a little bit hotter than the market expects. We see a little bit of equity market selling, maybe some dollar strength as a result. You know, listening to what the Fed chair has to say in a couple of weeks when we get to, I can't believe I just said
when
it.
we dive into the hole.
Yeah, in the bunghole, the Jackson's bunghole. When we get there, the problem is going to be, or what could happen is, you know, maybe we see a shift in narrative. Maybe we you know, hear central banks say, yeah, you know, we're going to have to just deal with higher inflation. This is kind of, you know, we're not sure if we're going to get back to 2%, or perhaps, you know, they stay the course and the Fed chair says, hey, we are going to have to stick with, you know, we're not close to the fight to finishing the inflation fight. Then the market's going to have to start pricing everything out going into 2024 and the rest of the year. So it's going to be a really interesting couple of weeks. And remember, it is summer and there's a lot of people out. Ryan's out, Steve's out. There's, you know, a lot of people, and I'm just naming off people from our team, but I'm just saying there's a lot of people that are away. Liquidity is going to be a little bit poorer. That means volatility might be a little higher. We might see some spiky action today. And I want to start with all that. I want to go to the S&P. And let me just point out the really key developments that we've had. The S&P has stopped at the 618 retracement, big support zone, big breakout point, and that comes in around 4450, 4450, 4460. We went as low yesterday as 4470, whatever. If you're in the S&P room, in the ForexAnalytix S&P room, here's the general chat room. But if you were in the S&P room yesterday, you saw those charts that we posted. I don't think anybody was shorting into that data, into these levels that we were all just talking about, really key levels that we were at yesterday. So with that being said, you know, knowing where we're at today, I think, you know, your line in the sand. I think if the inflation data is strong and we start trading below 4450, 4460 in the S&P, that's where things get a little bit more dicey. You know, where we break out of this channel, we're already broken out of it, but, you know, you see a little bit of a trap door here between, you know, 4450 and 4300, which is, you know, another key level of support. But I think this is very pivotal. I'm not saying that you should be running out shorting equities right now. That would be the exact opposite. Matter of fact, I want to talk about what do you think, Stelios? Because you're an advocate, or you have been consistently saying for the last, you know, couple of days that you think inflation is still going to be receding a little bit. Maybe the data comes in a little weaker than expected. How would you play that? I think precious metals would play a little bit better, right? Is that how you'd play it?
They should do, but when I look at the two alternatives, so a stronger or weaker number, I want to look at something that's on the precipice. And metals, unfortunately, are on the precipice on the other side. So gold is close to support, not close to resistance. So yeah, I would rather play short gold on a strong number, because I think support will be broken while we're there, than long on a weak number. I'm not saying that they're not going to rally on a weak number. I think they will, but I think there's probably better things to trade, like, I don't know, dollar CAD or dollar Norway on the short side on a weak number.
Yeah, you know, and Horatio says, you know, how much does a strong number does the U.S. dollar need to be supported and not faded? You know, for me, I try not to come to those conclusions, and you know, Stelios and Kman may have a better idea. What we're going to be doing is we're going to be, identifying what the data is. And, I mean, for me, it's like, obviously if you start seeing CPI year over year, dipping into the twos, you got to be like, holy crap, I need to be selling dollars right now. But I think since I think the data is going to be fairly close to being in line, and as Kman pointed out, options are pricing in not a lot of volatility today. Hey, you identify if it's a little stronger, a little weaker based on expectations that we're seeing, and then you watch price action from there. I think that it's like a two-step process for me today and a day like today. But Stelios, Kman, do you guys have any comments regarding that? Like what you're looking for today?
What's going to be strong or weak? I've said for a while that not 2 days, more than 2 days. I've said for a while I think it's going to keep disappointing, and I actually think it might even be flat to the last reading. So if that's the case, obviously it's going to be a weak number. I think anything below expectation, the market is going to treat it as a weak number. And what scares me is I saw a chart the other day. CTAs pretty much limit short treasuries, bond, any kind of bond.
Yeah,
which is scary.
For months.
Yes, they've done well, but you know what happens when things start turning and CTAs start unloading? They're like a big super tanker turning, taking ages to turn, and they are massive. So if that happens and they start going the other way, they get the signal to go the other way or to go neutral, then I think 10-year US goes to 330 pretty quickly. So that's something that scares me when CTAs are all the same way in something as big as treasuries and bonds.
Then they think yields are just going to fly here, right? So
probably.
Kman, do you have any opinions here as far as CPI? Exactly what you would be saying is, oh man, that is extremely weak. I think if the year on year comes in at a 3 handle, maybe even lower. I mean, you got to be just shorting dollars at that point. But you have any opinions here?
No, absolutely. I mean, we've seen the correction already from the peak. I honestly think that some of those CTAs might have already done something because from those highs, because they are very sensible to turnarounds, and we are already 23 BPs lower from the top in the tens. But still, yes, I mean, there's what I said at the start of the show. There's some stuff that is in the FX market are stronger than others. I think if you get an overshoot, let's assume that we get an overshoot. I think stuff like the commodity currencies, China, yen are probably going to be among the weakest. And if you get a lower number, then you're looking at the other side. Perhaps the euro, sterling may jump. Norwegian krona could do well. I think that's mainly it. It's my exercise of finding the weaker and the stronger currencies to do either side.
Yeah, I agree with you, Kman. And yesterday during the Morning Edge, that's a private show that we do amongst the ForexAnalytix community. You look at like Kiwi, for example. I mean, we know we're on really critical support here. I mean, this is like the range lows. We finished a bear flag pattern, or close enough, as Dale, you'd say, close enough for government work, right? We got really damn close, and I would say that is complete. These are the currencies that you play on the long side should inflation continue to just continue to moderate, and as the world comes back to some sort of normalcy. And if Stelios is right, you play the Kiwi off the lows, you play the Aussie off the lows, and Kman, just as you said, you got this US dollar Norwegian krona that's got a bear flag pattern that can't get back above the 200 DMA. I mean, these are all really, really good setups to play, dollar on the short side. And I think, Kman, you brought it up just a bit ago. I mean, the euro, it's buoyant. I mean, it's holding up against so many cross rates. The euro gets back above 110.50, and you got to be like, okay, well, here's the longer term channel, and we can't get below like the 50 DMA here. The euro breaks above 110, and we're trading back to 112. I mean, it It is summer. Let's not forget that. Volatility tends to be pretty low, and you always hear the old adage, don't short a dull market. Well, last couple of weeks of summer might be rather dull. Perhaps the dollar, grinds lower. Flip side to that is, we get some strong data, and I think that you're going to see a lot of these currencies get taken to the cleaners, and we're so pivotal. Like, you look at the Aussie, and you take a long-term view, right? You kind of zoom out a little bit, and you start looking around and realizing that the Aussie looks like absolute garbage compared to other risk assets. The crap could get beat out of the Aussie if this data comes in strong. I mean, you go look at copper. Copper looks like a big failure. You start looking at China, and you start thinking China's a big, just a big fail from an opening standpoint as an economy. This year, they've really underperformed analysts' expectations. So, you start talking about really strong inflation. It's not going anywhere. These higher energy costs are going to feed into, consumer spending. It's going to really start to bite. I think you can play this either way, and it's all going to feed into Jackson Hole going into later this week. And or later this month, excuse me. I want to just really quick, and then we're going to get set up. I want to cover just a couple other indices really fast. You got the NASDAQ 100 really sitting on a ledge here, false breakout, 161% extension rejection. We're sitting on the support zone. We're sitting on the 50 DMA. Dale, if you see the generals go, Microsoft starts to go, Apple continues to weigh on the NASDAQ 100, you're going to see this break down below 15K. NASDAQ 100 breaks below 15K, and
you know what else, Blake?
Trap door there.
People were trying to rotate into Russell, but if you look at IWM, it's an ETF for the Russell.
Failure.
Yeah,
double top.
Just cleaned out some stops. Yeah.
Yeah, I mean,
look at the
doesn't
banks.
look pretty, man. It does not look pretty.
Yeah. So I mean, it didn't do much compared to what NASDAQ and S&Ps did.
Right. No, 100% agree. Hey, by the way, I know he's listening in because I just looked for his name. Scott, congratulations on the trader funding program. He's going live. He passed yesterday. Congratulations. There's been actually a lot of people that are now trading our capital. If you want to learn how to trade our capital, go to the traderfundingprogram.com. You can find it on the ForexAnalytix website, right on the homepage. So congratulations, Scott. Looking forward to you rocking and rolling. You can find us right here. All right, let's go back. Let's get ready for today. Get ready for the data. We've got 2 minutes. Kman, Stelios, Dale, as I get set up, any last minute comments as I get this all set up?
Yes, I'm very surprised you didn't even talk about Banxico, Blake.
I'm so disappointed. We got to save for our people.
All right,
go ahead. Talk about Banxico.
No. I mean, it's expected to be kept at hold. But yesterday, the inflation also in Mexico showed a little sign of weakness. So I think there is one outside chance that they may do a 25 BP cut in line with what Brazil did, but that's not the base case. And we are going to be keeping a hawk eye on this 17 level where we are on now, exactly, on the dollar mix. So that's
and just remember, there are a lot of and here, let me get rid of this really quick. There a lot of LATAM currencies and countries, excuse me. They are embarking on a rate cut campaign. So this is going to be it's going to be a big deal today, right? With Banxico.
I reckon so.
Yeah. And Kman and I are both very, very much in tune to what's happening there. So here's your data flash. This comes with ForexAnalytix. You can see CPI down below, but we also have weekly jobless claims that are coming out. You got bonds over here to the right, S&P right in the middle, and you have the dollar index right over here to the left. We're going to just kind of see the instant reaction for everything. Last minute thoughts. We got 30 seconds. Stelios?
No.
Dale, coach.
No.
Oh gosh, you guys. Kman, I know you just said Banxico.
I'm staying with the short crude that the numbers won't affect.
Everybody's leaning into weak dollars. Look at the Kiwi is screaming into this, getting hit right here as we're heading
Does
into
somebody
this.
know something?
Yeah, dollar
see.
yen's under
But
pressure.
they're all scared.
Good.
Whoops.
Oh, stocks are ripping.
3.2. Okay, so it
0.2.
disappointed slightly.
Weekly
Core 0.1
jobless
lower
claims
as well.
They are a little worse than
There goes
expected.
the
So
dollar.
yeah, we're seeing the dollar get hit here.
S&Ps are blowing.
They are. Let's take a
Yields are
look at
dropping
what's
for
happening.
Stelios.
So here's the S&P. Now this S&P
Oh, look
just
at that.
spiked up, stopped everybody out.
Yeah.
And now what happens from here? The cable is ripped higher above 128. Now 128 is pretty big resistance in the sterling. Just keep that in mind. This is actually the underside of the previous channel. So we're right here. You know, we've moved to that point where I think the market just could stop out a lot of people and quite possibly reverse.
Yeah.
So just keep that in mind. Wow. But look at the Kiwi, look at the Aussie. These are ripping higher due to the weak inflation. We're seeing us move higher, and S&P looks like it is supported here. So we might get that lower volatility going into summer, and maybe the dollar stays a little weaker. What do you think is going to be the messaging here, Stelios, moving forward from the Fed?
I think
Victory, mission accomplished.
The trajectory is still the right way for them, and I think they're going to be more at ease to potentially not hike again, at least until they see how things develop in the next month. So I think probably leaning to the dovish side going forward.
Leaning to the dovish side. There we go. Kman, any final thoughts before we pass it over to Dale?
No, not really. I think it's pretty logical. Guess the market was waiting to see if this would confirm a higher print as expected, but it doesn't. So no, I mean, I'm not going to chase anything else. I did buy a few euro dollar, by the way, but it's going to be a very tight one.
All right. Well, keep it tight. Keep it safe today. Remember, we are in the summertime markets, so summer doldrums. And I'm seeing the S&P's spiky higher and are coming off a little bit. So careful chasing everything today. And I want to say thanks everybody for being with us. And remember, we're here every day at the same time, same bat time, same bat channel. Is that what they used to say, Dale?
Yes,
Batman.
sir.
Adam West.
That's
Yes.
right. That's right. There we go.
Yeah.
Thank you. The late great Adam West. All right. Stelios, Kman, Dale, thank you so much.
Thanks,
and
Steve.
thank you all for listening in and spending your time with us. Dale, I'll pass it over to you. You have your interview
Yes,
is here. All right. Great.
Jerry is here.
Great. Have
All
a
right.
have a great interview with Jerry. You guys stick around
right.
for Dale and Jerry, and we'll see you guys tomorrow.
Jerry's going
PPI.
to tell us follow the money. And thank you, Blake. Came in. Stel, good luck today. And Jerry Robinson, welcome back to F.A.C.E. How are you, buddy?
Oh, it's great to be here. Thanks, Dale. Nice and early in the morning here.
So it's been a while. It always is when we get back together. Top of mind for you, Jerry, in this environment here.
Well, we're certainly seeing a pullback, and we're certainly in perhaps the early stages of what may be a deeper pullback as we move into the notorious month of September.
Okay.
You know, September
So it's
historic.
seasonal.
I believe it's seasonal. I believe that there's some seasonal aspects. We've had such a strong run in the stock market rally. In fact, I can pull up some charts.
Okay,
Would you like-
go
would you-
ahead. I'll stop sharing.
Would you like me to? Okay, let me go
Yes.
ahead and do that. Let me
Go
grab this. Yeah, that way we can kind of talk through some of these charts that we're seeing. Let me just
Okay.
refresh here. We'll begin with the S&P 500. You know, we've had such a great rally. It's really been something, you know, one for the books.
It has.
Yeah, it really has. And the last time you and I were sitting here talking, there were many more bears than there are today. Maybe it's starting to even out, but
I'd say most people
go
are
ahead.
saying, correction. No
Yeah.
one's saying the end of the move. I'd say most people are saying just a normal run of the mill correction, maybe 10%.
There you go. Exactly. I mean, take a look at this S&P 500 chart to really get it in focus, and you'll see we haven't even touched the 50 yet. So we haven't touched the 50 SMA since March. We were in this kind of tight grind around the 200-day, which is this yellow line. We were grinding around it. We finally broke free back in March, and then broke out above that key 4275 area, which was hampering us back in August of last year. We got this nice rally right along the 14 EMA, which is usually a nice area. Some people use the 20. I prefer the 14, but really just whatever you use for a short-term MA. But we lost that, and that's usually the first sign, that we're going to see something perhaps deeper. And then you get to the 50, and right now we haven't touched it. So it's very possible that what we have here is a pullback to this 50, a negotiation with it, and then a rebound. That's one scenario. Another scenario is that we come down on the S&P from where we are now, 4467 or so. We lose 50, and we come back to this key support area of 4275. That probably is perhaps more likely. And then, of course, a pullback all the way back to the 200-day would probably be unjustified, I would assume, based upon everything that I'm seeing. So we're of the opinion that 4275 probably going to serve as the area where we get the a bounce. In fact, I'm trying to clear my charts here. How do I clear? Let me see. Clear all drawings. There we go. Perfect.
Okay, so what about yields, Jerry? The bonds, TLT, you have a view on them. People keep bringing up record short positions by large specs, and they've said that for a month, yet yields kept going higher. But today may be a different story, but I'm wondering what your view is on yields here.
Well, I think part of it will be determined by Thursday's CPI print. So that is, well, actually, here we are this morning, which I guess we're going to have it. We just got it. Okay, I haven't even seen it. What was the number there? Let me go double check it, because that would really.
I forgot the number, but yields came down.
They came down. Okay, that's good. Yeah, we were watching for that number this morning. Yeah, the CPI rose 3.2% from a year ago in July, less than expected. 3.3% was what they were pretty much focused upon. So it's a slightly, of course, we'll get the PPI numbers tomorrow, and that'll also help us. But yeah,
NASDAQ on the 50 compared to S&P. So NASDAQ led the way up. NASDAQ's leading this pullback.
Absolutely. Yeah, we've seen the weakness in tech. We've seen, in fact, for a long time, tech was the big winner for the year. We've since seen it replaced by communications. In fact, let me pull up one other thing that I want to show on the screen here before we get back to the charts. This is the Robinson report. So this is something we put out each weekend for our members. And when we come down, there's a couple of interesting things here. The first one is just the year-to-date gains as of the weekend. So, Bitcoin is the big winner year to date. Of course, if we're looking at the 10 major markets that we track right here: Bitcoin, Ethereum, NASDAQ, S&P, Russell 2000, crude oil, gold, dollar, China, and silver. Silver's the big laggard for the year, the only down market as of the weekend. Bitcoin, rip roaring 75%, Ethereum up 52%. And the NASDAQ 40%. So again, any kind of pullback in this environment on the NASDAQ, is probably healthy at this point. I mean, after a 40% run. Let me show you one other thing too.
Do you like NVIDIA and Apple?
Absolutely. Those are two of our largest holdings. Absolutely. Yeah. Those.
It doesn't bother you that Apple gapped its 50-day moving average?
Well, I have a 10 plus year time horizon on the holding, so it's not a trade. Okay. So yeah, I consider
you buy more at 115.
I buy more. Oh yeah, I buy more.
At 115, not 150.
I have a chart on Apple. Let me just pull that one up, because that might be instructive on that topic. Let me see if I have that Apple chart handy here. I'm not seeing it. Oh, well, maybe that's it. Oh, here it is. Here it is. Yeah, this
Oh,
is kind of a
okay.
little bit of a sloppy chart. I'll show you where we consider the long-term opportunity
116.
zone.
Yeah.
Here it is. Okay, here it comes. Again, a sloppy chart. I haven't updated it in a little bit, but here's this
Okay.
long-term opportunity zone, as you can see right there, right below that 200 right now, but it's right in between 120 and 90. We didn't enter it in the
No.
beginning of 2023. I was hoping for that opportunity. We didn't. Anything in this zone here for us is just, you know, a gift. And I don't suspect we'll see it anytime soon, but again, look at Apple. This is a weekly chart. So, you know, you're not really seeing the 50-day, but, you know, we're miles above the 50 weekly. And of course, as well as the 200 weekly. So we've had a really big rally there. Now, on the sector side, communications overtook tech, and consumer discretionary. These three, as you know, have been leading the whole rally, you know, all year long. We finally started to see it move into other things like industrials, which has been been in fourth place for much of the year. Basic materials been fighting for that fifth place all year long. Utilities and healthcare are the place not to be apparently right now. But although from a long-term perspective, those are pretty attractive. Energy's really starting to pick up in July, where we started seeing oil prices spike on fears of tightening demand, tightening supplies, Saudis cutting their projected output, Russians, kind of joining them. And so we do expect energy stocks to probably continue pushing higher through the end of the year. And then real estate, of course, we think is another great attractive space for long term. There's so much turmoil there. But
what
back
do you
to
think
the
about what's happening with the banks, Jerry? I mean, you look at the whole picture.
Yeah.
Do you think we have a banking crisis here in the U.S. and that there might be kind of an end game to create distrust of the banks and create enough fear so that the public will embrace CBDC as a savior?
Interesting. That's an interesting way to put it. That's not necessarily what I'm thinking. When I look at the banks, I see this as kind of a big consolidation opportunity for the big banks. I think the big banks are excited about the regional bank fears.
Citicorp, look at that chart. It looks as bad as the regionals.
Well,
Citicorp.
It may be. It may be. In fact, we can look at that. But let me just type it in so we can see.
Anyway, I'm just wondering what you think of the Fed. So I mean, after this number, maybe they're taking a hike off the table in September, but I don't think they're through. And I think this whole CBDC thing is a takeover of the Treasury by the Fed.
Yeah, I can see your point. But in many ways, the CBDC is already here with FedNow, with the FedNow payment system. In many ways, our dollar is already digital. I'm opposed, of course, to the controls that the CBDC would have. I mean, quite frankly, Dale, I mean, in my book, Bankruptcy of Our Nation, I call the Federal Reserve a fraud. I mean, it's
Jekyll Island stuff.
Yeah, of course. Yeah, it's a terrible thing that we've kind of handed over our monetary sovereignty to this entity. And then, of course, the CBDC doesn't make it better. It makes it worse. But when it comes to the banks, the big banks, I think, are excited about the regional banks' fears, and they're benefiting from it, obviously. And so,
not Citi.
Well, maybe not. Maybe not their stock price right this second. But what I mean is that over time, they're going to benefit.
They're gobbling them up.
Yeah, exactly. They're gobbling them up. And but as far as the banks, I don't tend to invest in the financials. The only thing that comes close to a financial for me that I invest in would be Visa. And I think Visa is well positioned. But again, you could flip a coin with MasterCard or Visa. I think either one, is going to do fine over time. They're staying out ahead of all this. But as far as the banks go, I don't tend to invest in them. I do monitor them for our members. Now, when we turn to something like gold's been holding up a lot better than silver.
Yes.
Gold
silver ratio.
Yeah. Oh yeah. And gold has been looking pretty darn good. There's that gold silver ratio, still favoring silver and even heading in that direction. There was I think we were talking about this last time with gold, that we saw just from a technical perspective, for those who like to do technicals, like we do, there's this interesting, let's see, where's my pen here? There we go. There's this interesting phenomenon that happens on charts. I'm sure many of your listeners are familiar with, but this is often a really helpful tool where you get these long wicks, especially like on a weekly chart. And those long upper wicks will show a rejection of higher prices. You see it here. We get this really long wick, and then the body is way down here. Well, that's kind of a sign that it's rejecting those higher prices. Likewise, whenever you see a long wick on the bottom right here, well, that's kind of indicating that you're probably going to move higher. They're rejecting lower prices. There you go again, long wicks on the bottom, and then indicating very likely we're going up. And then, of course, when we get up here, we started seeing these long wicks to the upside around 2000. So we said, well, this looks like it's going to reject higher prices. We came down, and then we got a little rejection of this around 1900. We've really held 1900 well. And we're just bobbing back and forth now between, 2K and 1900 on the price of gold. It's holding up, as I mentioned, better than silver. When we look at silver, it's down here. Let me bring it down there. We'll get to the dollar in a second. I just want to look at the silver chart real quick. Where is it at? Silver. There we go. So, this one looks a lot worse. We just lost the 200 SMA, of course, on silver for those who follow silver. This one has just had a tough time overall. It's still in a bullish channel. I mean, overall, we have this nice bullish channel that's going on silver. $22 is a major line in the sand. But this 2450 resistance overhead, this 200-day moving average, the 2330 support has now turned into resistance. The one moving average that we use consistently with silver on a daily chart is the 30 SMA. We've been using that one for years. It's a really interesting indicator on silver. So we do watch it very closely. We just lost it as well. So silver breaking down, you can only assume that has to do with recession fears. It's very difficult to know what people are thinking, Dale. I mean, I've been doing this a long time, and we have $5.5 trillion of money on the sidelines. We have hedge funds acting like it's Armageddon, but then you look at the bigger asset managers, and they're seeing blue skies. So
a lot of conflicting things.
A lot of conflicting things, right?
And then does your head ever explode?
Right. Well, sometimes you wonder, but yeah. So it is a little, and for the average bear out there who doesn't look at this stuff all the time, I mean, I would imagine they're very confused as to what's going on, and I wouldn't blame them whatsoever. Now, the dollar is also very instructive. We have a dollar chart here. Let me come back up. Sorry for the headache if it's this zooming, moving.
It's okay. I took a Dramamine.
So the dollar, this one really tells a story. I like this chart.
What, the false breakdown and then back above it?
Well, but also just the lower highs that are just consistently happening here. We got a real bearish channel here. So the dollar keeps kind of faking us out. It'll go down, 2 steps, and then it'll come back 1 step. And that this right here really tells the story of what we've been going through over the last several months and pretty much all year. Is that
but Jerry, when you admit when we took out that 101 dotted line, that it looked like a breakdown, and people were coming up with all kinds of downside targets based upon a breakdown of that triangle. That's how you could get 85, because there's a 1400 point formation.
Yes.
And then within a matter of days, we have a breakout failure back above your red dotted line. I think there's still a lot of more dollar bears out there than dollar bulls.
So many. And the 200-day now
get squeezed.
Yeah, that's true.
How about up towards your upper red line?
Yeah, these are the areas that I would say, if we really get a rip-roaring dollar rally, which again, I'm trying to imagine what this would look like or how it would happen. You would have to have something that comes out of the blue, because right now the path of least resistance is this bearish channel. I mean, we're really kind of moving in this, but to really get escape velocity on the dollar, you would need some sort of material change. And I don't know what that would be, but the 200-day moving average would be a bear to get past. As you can see, we haven't been past it since we lost it. We haven't even tested it.
Come in 3.5.
Yeah, about 1.5. Yeah, 103.50, and then Oh, the key area, of course, is a sloppy chart. I haven't updated in a few days, but as you can
I
see,
like it. Yeah.
yeah, but you
Nice.
can see that this key area up here. I mean,
Yeah.
this
That'd be a
this would be
natural.
that would be the extreme upside that we could possibly see that on some
Okay.
sort of rally, but we don't see that happening.
Okay.
In fact, what we see is quite the opposite. What we expect. Let me get back to where I can. There we go. What we see is this dollar coming back down to where it was back in the 2018
okay.
area, about 88 or so over time. And the reason for that is because, currently interest rates are what, 5.5% or whatever, the Fed rate. And this is the actual historical rate that we've seen throughout history. This is what we normally see. 5.67% is the average Fed funds rate going back for 30 years. So we're kind of right there at the average. Now, it doesn't feel average to the average person because they're thinking, wow, this is really high. We've had low rates for a long time. But now we're back at 5.5%. Well, clearly that 5.5%, give or take a little bit, is hurting people. It's hurting business. It's hurting the government. It's hurting consumers. And the Fed has one button, and that button is lower and raise, so it's a switch. And so they've raised their interest rates, and they want to lower rates. I mean, they definitely want to lower rates. It takes them out of the focus. It takes them from having to take the blame. They want to get out of the picture. They'd like to start lowering rates. You get the sense that investors already know this, and this is why markets have been rising, because markets are usually forecasting 6 months ahead. We suspect, as you had pointed out, that we're probably not going to see another rate hike. That lag effect as well has to be stated. For those unfamiliar with the lag effect on the Federal Reserve, when the Federal Reserve acts, when it makes a move, when it raises interest rates, you may not see anything for a while, and you may not know what the full effect of that single rate hike is going to be until months in the future. So when they raised the way they did so aggressively last year, we're still seeing the impacts, and we may not know the impacts fully for another few months. And the Fed knows this. And the Fed also knows that when it starts to cut rates, it's not going to immediately help. It's not going to immediately help. It's not going to immediately change everything. There's going to be a lag effect to it as well. So they've got this timing with this lag effect that they're trying to manage like a tight wire. And so I believe they're going to start cutting earlier rather than later. So I could envision, this may sound strange, but I could envision the very first rate cut in September. Now, I'm not saying it's going to happen. I'm saying, we've been saying, as early as September, they could offer the very first rate cut or language that indicates that they're getting ready to move into it. So either A, a material rate cut in September, or B, some sort of softening of the language that allows the investor to realize, okay, we've really reached the terminal rate. But by December, Dale, I would suspect that we will have the first rate cut in our hands. It may boost a Santa Claus
because
rally
the unions are having their way, Jerry, with corporations. Yeah, we're having major wage increases. I mean, even Social Security, the COLA went up.
Yes.
That's pretty ingrained. So grains. So you could have commodity prices fall, but you get a wage price spiral going, and the Fed isn't done. And all the unions are, you don't see any strikes, do you? They're all settled, and they're all going, not Hollywood yet, but I mean, industrial America. They're giving unions what they want. So
yes,
that's inflationary.
Indeed, which builds the case for keeping rates higher longer. And and there's a case to be made for that.
So why would they pivot with the S&P only 5% off all-time highs? Don't you think it would take more of a financial emergency and much lower numbers in equities for the Fed not to pause, but to actually reverse and start easing? Why should they do it up here?
If they learn nothing from history, you may be right. If they learn that they usually are they lack good timing, then you would be right. I mean, I think whenever when we look back at the rate hike campaign of 2022, many people try to figure out why was the inflation in 2022 and not say in 2021, or why did we not see it in 2020? Why did it start soaring in 2022? Well, this goes back to the whole lag effect. This goes back to the whole idea that you could do you could implement some sort of policy, but it doesn't stream down to the whole economy for months and months and months. This is why it's pretty unfortunate for President Biden. And I hate politics. I'm apolitical. I don't care who you vote for. Anybody listening, I don't care who you vote for. You vote for whoever you think. But I think it's unfortunate for Mr. Biden because if you look back at 2020, we had more money printed in the month of June than all of the money that was printed before that from the beginning of time, from the beginning of the time of the United States, 1776 to whenever. So there was a tremendous amount of money printed in 2020. Okay, but it takes a minute. That money just doesn't immediately go out to where it's going to be. It takes a minute to really, flow through the economy. And so by the time we get, a year later, you're really starting to see, wow. And then of course you got supply chain constraints, and you've got a Ukraine war, and you got all these other things. Well, you're simply, and then of course you have the energy cycle, which, really tends to peak right before the bear market. And we got all of that. And so now the Fed played late. It should have got ahead of it. It should have known that it was coming after printing all of this money. And they didn't. They didn't do it until, sometime in 2022. Then they start raising rates, and they're raising them at a pittance, 25 basis points here, 50 basis points here. And you're thinking, okay, well, they've got to get ahead of this. Well, they didn't. It took them a minute. And now they finally got to a place where now inflation is lower than the Fed fund rate. Well, that's where they feel comfortable there. And as long as that inflation rate, typically they'll look at the PCE, but oftentimes even the headline rate. They want that headline rate below the Fed funds rate. And right now it is. And so as long as that stays that way, you would expect they'll lower rates as long as that headline rate is staying below their Fed funds rate. So I guess what I'm saying is that over time, they really need to get out ahead if they're wanting to drive down rates, and if they want to start easing. Well, they can't wait till we have financial Armageddon on the scene. They've got to get ahead of it, and I think they know that.
Yeah, Jamie Dimon said in a recent interview that Powell needs to take another look at his models. Pretty
Right.
Smart guy. So
yeah,
best way for people to follow your great technical work and how you marry fundamentals with it and work
Absolutely.
with people in your community, buddy.
Absolutely, Dale. Thank you. Followthemoney.com. We've been here since 2010, helping people all over the world just provide,
That's staying power in this business.
Yeah, thank you. Yeah, thank you. We've been here for a long time, and we plan on staying here for a long time. We have a lot of members around the world. They get a weekend report we put out with a video, kind of wrapping up the market, providing great ideas, trading ideas, and investing ideas. We do a live webcast every Tuesday for our members. That is an hour long, just lots of great information for investors and traders. And we have a free podcast, all of it, followthemoney.com. They can find out more information there, and they can begin by just signing up for our free newsletter right here on the front page.
Great, Jerry. Well, my trading warrior brother, I hope you have the rest of the summer, which, still about 6 weeks, great trading season, and look forward to catching up with you in the fall. And we'll see if the Fed is easing by then.
I totally agree. And I want to say something to you real quick, if you'll let me just for a second.
Yeah, sure.
I've been following your Twitter a little bit, and I just want to say I want to thank you. You've been inspiring to me because you have been so bold in your witness for our Lord Jesus Christ. I mean, I've just got to say, as I've seen some of your tweets, it's almost like God drops them in my lap, Dale. I was just the other day. I just want to encourage you in that. Because I was on Twitter. I rarely get on Twitter to dilly-dally. But I got on there, and the very first tweet was Dale Pinkert. And it was talking about, how God calls and how you're equipped and you have everything you need for your calling. And it was just a word in due season. It was a really great moment. And I was like, wow, Dale, what a guy. I mean, what a guy to remind his audience about the important things in life, that it's not about money, that it's not about all these things. Obviously, we want to be good stewards of what we have. But I love how you front load that. You know, by the way, for those who are, if you're into that, we actually, you may not know this, Dale, but we have a ministry, and it's called TrueRichesRadio.com. I've been running that since 2010 as well, and it's all about, you know, the Bible, and about, you know, it's a different kind of approach, more of a kind of a nonviolent love of friends and enemies that Jesus displayed. So
well, you know,
anybody who's,
Joseph is my idol, is the best commodity trader of all time. Right?
that's a
7
good
years
one.
of
That's a
plenty.
good one. Well, that's right.
And you know what, Jerry, I like to encourage people, and those are mainly Joel Osteen's prayers that I post
I
up there.
see.
But thank you. And I've said I'd rather lose followers to be one.
Oh, thank you for not being bashful. Thank you for
Okay,
not
buddy.
being bashful.
All right, bro.
All righty.
Jerry
Thanks a bunch.
Robinson, my trading warrior brother, and brother in even higher ways.
Amen,
So,
brother.
all right, nice talking to you, Jerry. I'll be in touch with you.
Okay, see you soon.
All right, adios. So that's a wrap, everybody. And yeah, check Jerry out at Follow the Money. What a great name. They a lot of people appreciate what you had to say, Jerry. And check out he's got a good feel for the macro in the markets, and could join the team in about 14 minutes on the morning edge. And we'll wrap it up all tomorrow for you guys. TGIF. Good luck the rest of the day. Good hunting, and don't just count your pips, count your blessings. You're very welcome, AJ. And thanks again, Jerry Robinson. Follow him at Follow the Money, FTM, at FTM. Adios.